Welcome back to Switzer. Rudy Philippek Van Dijk's FNArena surveys stocks and what the expert analysts say. And Rudy surveys them. So what has his surveying surveyed? Please welcome my favourite stock surveyor, RFV, Rudy Philippek Van Dijk. How are you, mate?
I mean, I like the intro. I mean, $1,000 worth at the very least.
I've never called you RFV, but you deserve that. That's
my initials.
Yeah, your initials, without a doubt.
I have to put it up in neon sign.
Yeah. Jokes aside, that's what FNArena does. You survey the analysts, and after reporting season, it's a really good time to see what you're surveying. So, what have you surveyed?
Well, what have I surveyed?
Stick to stocks.
Some people think that the reporting season was moderately disappointing. If you take the view that, if you take the angle and you try to assess what the reports, the company reports have done, their impact on analyst forecasts, then this was the worst reporting season since August 2008. Now that says a lot. It explains, for example, why this share market just doesn't seem to get any upward momentum. We can all talk about international influences, and yes, they're there. The currency, bond yields, Federal Reserve, Trump, North Korea. I mean, there's plenty of them, but it also comes from within. And within we have disappointment, we have dividend cuts, we have defensive capex, we have companies that somehow don't seem to be able to match analyst expectations, and that's not a good thing because it takes momentum out of the share market. And obviously we have the occasional scandals here and there, and we have electricity prices, and there's plenty of people to disappoint for that.
Yeah. You're talking headwinds, aren't you, really?
Headwinds, yes. And probably also good to point out as well, and this is, I know you like a good news story, but every once in a while we have to point out some facts as well.
Hey, I'm not Carson Scott. Carson loves a good news story. I like facts so we can make money out of it.
There you go, facts. Here's the facts.
Okay.
If it wasn't for the dividends, we had no returns, and this is month number 9 in the calendar year.
That's true.
Which is, I mean, it's a raging bull market in the US, has been so far, the second strongest on record. And it somehow hasn't rubbed off on Australia.
But Rudy, let's be fair. Part of the US stock market rebound has been a thing called a depreciation. We had our appreciation, and they've been depreciating their currency for what, since the GFC in many ways.
Well, Peter, every success story has many fathers, and of course, I mean, the Federal Reserve, the currency, they all have contributed government policies as well over there, but that means that we have no fathers because we obviously have failure. And I had a quick look today because it occurred to me, and I asked around and nobody knew the answer to this, but I think I'm pretty correct because if I remember correctly, I actually heard you saying this once on this channel, that it has never happened before, that if the share market goes through a tough phase, which it did in 2007, 2008 and 2009, that over a 10-year period, the share market doesn't at least go back to where it was.
Correct.
And you know what? We're about to hit the 10-year period since late 2007. And I'm willing to take, I'm not a betting man, but I'm going to take this bet. We're not going to get there.
No. In fact, my argument is, and this is based out on theory, history, that we've never had a crash before we passed the all-time high. And fortunately there's such a long stretched out bull market driven by low interest rates. We still might do it, but you're right, usually stock markets will go up over a 10-year period. You might have 2 or 3 bad years, but I think you kind of spliced them both together. But the bottom line is usually in a 10-year period that would have happened.
And I'm also taking a little bit offense on your usage of bull market here, because the index is where it was in mid-2007. That's 10 years.
Yeah.
It can't be a bull market.
Yeah, yeah.
On anyone's definition. On anyone's definition.
Anyone's. I think you go to the low point first, don't you?
No.
And then
I just go 10 years back.
No, that's the Rudy Philip Van Dyke definition. I think you look at the low point, and if it's going up over a succession period of time, it's a fair call to call bull market. But let's not split hairs over it, because you've got a lot more than me, Rudy. Let's go and do what I asked you to do.
I would hope so. I would hope so.
Because you're much younger than me anyway. So let's just go and do what I asked you to do.
Younger.
Go and look at your FNArena website with all your surveying. What are the stocks that actually have impressed during reporting? Big story, big picture, not impressive. No. But there's been some companies that obviously are worth following as a consequence of reporting season.
Well, here's in general terms, and this also harks back to, because I'm pretty certain if we go back to 2007 and take a look at the companies that have performed the best over that period, then the same thematic comes out, because when the going gets tough, the tough stand out. And unfortunately, the way the share market works, that means those companies are never cheap. And I always say they're not cheap for a reason. And one of the standout stocks I would, for example, I would definitely put forward is CSL. Now, everyone will tell you, you cannot possibly buy CSL because it's on too high PE. Yet, what I notice is that, for example, Macquarie last week, or it was even this week, over the past week, has reinitiated coverage on CSL. Now, outperform at the current price, at the price target of $146.
Yep.
That means that while and that's literally printed in their report, while the stock looks expensive, it actually isn't. And I think there is some considerations here that investors should take on board, because I have been following, as you know, CSL for quite a while.
Yep.
In 2007, when it was in the 30s, it was expensive back then as well. It looked really expensive. I remember the PE was close to 30, if not above 30. It's not where it is today. And people would have said in 2007, you can't possibly buy CSL. Yep. So you go for a cheap stock. And a lot of those cheap stocks in those days, for example, I'm just picking one, but for example, if you would have picked National Australia Bank in 2007, share price was $36. You look today, share price is still cheaper than $36. So you would have had dividends minus a little bit of your capital. That is your return then over 10 years, bull market. Okay? But if you had CSL, very strong stock, but high PE, but very, very much growth under its belt. I don't know what the exact number is, but if you take a calculation, let's pick price, 36 as well. It's 133 or something it's today. Well, I don't have to take a picture, do I? I mean, the return is worthy of the usage bull market.
Okay, CSL, you've made your point. Come on, give us another one.
Well, I would, if I stay on the theme, one of the stocks that, on my observation, hasn't gone anywhere now for a while is called Aristocrat Leisure. And I also think that is undeservedly so, and there's probably a lot of currency impact in there. And Aristocrat, similar to a CSL, trades on a P above 20. Now, most people go, oh, can't buy that. Yes, you can, because this stock is more than likely heading towards $30 from 20 now, and it will be a similar story as CSL back in 2007. It's in the 30s, people go, oh, you can't buy it, and you look back 10 years later, and you have made this big return on the assumption, of course, that we don't have a bear market next year, but we shouldn't have one. But again, sometimes buying a high PE stock is the right thing to do. It's not because it's a high PE, you should automatically ignore it. And
fund managers like Charlie Oak can call them world-class companies, CSL, Aristocrat. Let's finish on this theme then. Have you got a view on Treasury Wine Estates? Because it is another world-class company.
Yes, absolutely. Treasury Wine Estates, I'm a little bit less sanguine. And that is, but I've also written about this a couple of times on FNArena. I can see the attraction. and the attraction is definitely there. They are very good in selling expensive wine to wealthy people in Asia, particularly in China, and their margins look okay, and they're now setting up a new French wine brand from scratch. That's all good, but that's 20-25% of the business. The 75% of the business is more run-of-the-mill 13 in a dozen wine brands and products, and that segment is actually quite under pressure. And if you look underneath the numbers, there has been no real advance being made on the operational side for 2-3 years now. So the question with Treasury Wines is, do I put a premium on a business that derives a premium of 25% of its business? If the answer is yes, then you buy today in the share price, and the share market is today telling you and me the answer was yes. But we both know the share market can be fickle, and there is this problem with what do you do with the other 75%? Well, at the moment it's also priced at a premium. Now, if you're comfortable with that, then Treasury Wines is definitely still a great buy. But you have to be careful, because if something happens at some point, we can have a new Domino's pizza out our hands, and that's the time that you don't want to be there. So it's still a great story, but you have to take on board it has a little bit of a higher risk profile.
Yeah, and all three companies you've mentioned have a potential currency benefit if the dollar eventually follows the script and heads down to low 70s.
Absolutely, but all three of them are leveraged to a more expensive or a comeback in the US dollar. Absolutely.
Rudy Philippek, Van Dyke, or RFV, great work.
You're all better, man.
I'll see you later.